Hello, hello. Hi, everyone. I guess it's 1 o'clock Eastern, and great. So, thanks a lot for joining. And my name is Sham Srinivasan. As you know, most of you have worked with us in Quantil, are working with us rather. So, this is our first ever webinar that we are offering to our customers. So, we've done webinars in the past with, being a podcast guest in various different podcasts, etc. But we thought it'll be great to bring experts in various different fields related to finance so that our customers can benefit. As you all know, we started our estate and trust planning. We also have got some services in the tax planning area. We are bringing in some partners there. So we recently announced a new partner, Lakeline Tax, and I'm very happy to introduce Lakshmi Ramkumar, who is the CEO of Lakeline Tax, and she's been running this business for more than 5 years. She's got great experience for more than 10 years in the field of tax planning and advice, particularly for HNIs. So she's based out of Austin, Texas, but she's got clients all over the US. In fact, all over the world, I would say, right? She's got a lot of clients who file taxes in the US from various different countries. So, with that quick introduction, I would turn around to Lakshmi to introduce herself to all our clients, and then we'll start a very engaging Q&A with her. Lakshmi, on to you.
Good afternoon and welcome. Thank you for taking the time to join us today. I know that everyone here has significant demands on their attention, capital, and calendar, so I truly appreciate your presence. Thank you, Sham, for having me here to talk about tax planning. I've been a tax professional for almost 23 years now, and Lakeline Tax was started with the thought process of how a lot of people were missing deductions and were not taking advantage of the potential tax savings that are legally available to them. This is due to the fact that taxes are often thought of only after the income is made and without proper tax planning for the future. Now, I have various types of clients since I've been doing this for 23 years. It prompted me to start on my own when COVID hit. Everybody was virtual, and that was the best time to start. And thankfully, everything went booming. And I have clients all over the country and also from other parts of the world where they're U.S. citizens and they need to file taxes here. Now, as far as my clientele, I have high net worth clients who have lots of investments, properties, stocks, and RSUs, whatnot, and estates and trusts as well. So we do provide end-to-end service, starting with the incorporation of the company business, and as well as providing tax preparation, tax planning, and of course tax resolution as well. And we do offer bookkeeping services as well. So that's overall. So when you go to someone, it's end to end, starting with the incorporation all the way till the planning portion of it and making the best savings for on your taxes. I want to begin with a simple but often uncomfortable truth that I've learned over years of working with high net worth families, business owners, and sophisticated investors like yourself. Most wealth is not lost in bad markets. It is lost quietly through taxes and timing and the lack of coordination between all of the three. And that loss rarely shows up as a dramatic mistake. Everybody might think, oh, I'm not doing anything wrong. I'm making money. I'm paying the taxes, whatever, and I'm good with that. But more often, it appears as missed opportunity to me. At Lakeline Tax, many of our clients come to us after they have already succeeded professionally, financially, and in their investments. They're making a lot of money. When we take a comprehensive look at their situation, we frequently uncover hundreds of thousands of dollars per year quietly eroding through avoidable tax trap. Almost without exception, I can say our clients tell us the same thing over and over. They didn't realize how much money they were losing or putting it on the taxes until we showed them what was not being planned and only reported. That distinction really matters because Tax compliance is only one portion of it, and it reports the past, whatever happened prior in the previous year. But tax strategy, it shapes the entire future for you and your loved ones. Many people assume their accountant and financial advisor are aligned and working together. In reality, that alignment is very rare. Most CPAs are rightly focused on accurate reporting and compliance, but they're not forward looking optimization. I'm not saying every single person is like that, but that's the truth of it. That's where Lakeline Tax is different. We partner not only with our clients, but also directly and indirectly with their financial planners, working side by side to integrate investment decisions with proactive tax strategy today and years into the future. Too often, we see that tax savings are missed because planning begins after the income is earned. At Lakeline Tax, we believe planning must happen in advance. So for next year, you should be planning now, or maybe even earlier than now. So you maintain control over both your finances and your investments. I firmly believe we should never pay one more dollar in tax than the law requires. That's the truth of it for all of us, including myself, right? That's why we emphasize advanced planning, not year end cleanup or planning later. The difference between reporting and strategy is where meaningful savings live. Today's session is about aligning investments with tax strategy, discipline with opportunity, and decisions with long term outcomes. With that said, I'm looking forward to a thoughtful discussion and to helping you view your investment and wealth with greater clarity, intention, and control. Thank you, Sham, again for the opportunity to have me here.
That's great, Lakshmi. Thanks a lot for that good introduction about yourself and your service. We see that every single day with interacting with the clients. We don't see the full picture of all the clients' holdings because some of them are taxable, some of them are not taxable. We
Right.
primarily deal with a lot of retirement accounts. I would say 80% of our accounts is IRAs. So we don't
Mhm.
really have to deal with taxes in the way that we do things, but we do have 20% of our money on non-deferred
Right.
portfolios, and even that we don't see the full picture. So when we see some mistakes being done by the customers in terms of just saying sell it when
Mhm.
market is down, they just sell without knowing what the implications are.
Right.
We see that that's a bigger mistake than just selling, right? Of course the stock may have
Absolutely.
been down. So where let's keep it interactive. I have like about 10 or 15 questions that we collected from our
Sure.
clients. So most of them are going to be like a 1.5 minute kind of a question.
Sure.
So at a high level, where do you see the biggest area of leaks that happen from a wealth point of view?
From a wealth point of view, the biggest leak is not planning it properly, right? So where it happens is when the ordinary income is taxed at a higher marginal rates, and then capital gains triggered without timing strategy. So net investment income, people don't realize that net investment income quietly stacks on. When you have 100K of gain, you're paying 3.5%, 3.8% of net investment tax, which could easily be avoided or lowered by planning a little bit and timing the sale of the stocks or sale of property, whatever it is. And then there's always the state tax exposure that was never reevaluated. And the biggest one that I see is people who have businesses, they have the wrong entity structure for today's income. Those are the biggest drag I see, like the leak that I see, where people are not paying attention to it, and then it slowly catches up to you. It's not just one thing; it's a domino effect, right? You do one thing, and then it goes into the other, then it goes into that. So those are the main things. The capital gains timing strategy is one of the biggest
So
things that.
can I say that selling something on December 17th with a huge capital gain versus selling something 2 weeks later is a huge difference, night and day difference as far as the tax implications are concerned.
Absolutely, absolutely, because the timing is so crucial. If you're doing December 17th, unless you have some losses to offset, you don't want to sell a huge gain and then pay taxes come turn around April 15th. So definitely wait for 2 weeks, and you never know, you may be getting more income. The stocks may have improved or whatnot, and then you can offset some of the losses for the following year. So I would definitely say timing is very valuable and very important.
Can you talk about timing on, let's say we have some clients who have got quite a lot of ESOP, ESOP shares or ESPP that they have accumulated over a period of time, but
Sure.
they're sitting on a single stock exposure that we advise them not to have, right? That
Correct.
doesn't mean just blindly go and sell. Within that, there is a different sets of lots that they would have acquired over a period of time. Let's say somebody worked for a Google for the last 10 years. For the
Mm-hmm.
last 10 years that they've acquired, obviously the recent Google may not have appreciated as much as the early shares that they got.
Right.
Now if they want to go and reduce some exposure on Google, they have to obviously sell some of it. And now blindly selling, basically the rules in the brokerage firm could be that it's a first in first out, like the first
Correct.
list of shares would be sold.
Right.
Instead, should have been last in first out, and they have to consciously sell not just Google, but which lot of Google. Can you talk a little bit about it?
Sure, absolutely. That is where our the financial planner and the tax strategist come into picture when they join hands and when they work together for the best interest of your client or my client, right? So what happens is when they sell RSUs, when they vest, the RSUs vest, you're already taxed on the income anyways. So when you actually sell the immediate ones that you got it, let's say you got something in March and you want to keep it. I know we all want to keep it so to gain more profit, but what I would say is you want to choose between how much you want to pay taxes as well. You can plan in such a way that you can sell some of the stocks that are just given to you now, vested now, so you can get. I'm not saying you should sell it for a loss. It'll be a very minimal gain on that, so that way you can plan to not pay too much in taxes. And at the same time, if you're selling some from the older lot, you choose from some of the older lot so you have some gains, and at the same time, some from the current lot to offset that gain as well. So that is the way to do things. So that way, that's why timing is also important, and planning with your taxes and with your financial planner is very important in key stuff like that. Not everything has to be sold, or not everything has to be kept for 15 years, 20 years. So definitely, as the market shifts, we don't know what's going to happen tomorrow.
Right.
Like having the volatility that we have in stock markets, we don't know what's going to happen tomorrow. And like you said, December 17th may not be the right day to sell anything. So maybe 2 weeks down the road, you can look at what's going on, weigh in the options, calculate those, and make an informed judgment of how to mitigate the taxes to a lower tax bracket and not increase your taxes thereby. So that's
Great.
the best way to do it. Yeah.
Excellent, excellent. So when we talk to our clients, we talk about how, everyone in their early part of the career focus on what's their compensation is, what's their yearly increment is, and whatnot. They don't focus as much on investing in the market, because market is a biggest growth, biggest increment every year. If we focus in right style of investing, right areas of growth, etc., what the manager gives us as an increment next year doesn't really matter, because the market will give much higher increment for us just purely because of the wealth that's growing over a period of time. So most of us have got it wrong in terms of focusing on the minor 2%, 5% increase on a salary, and missing out the biggest increase of more than 15% in the investment that we have, right? So
Right.
similar to that kind of like thought process, right? When we think of like tax as a biggest draw, biggest basically pull down on your wealth, right?
Sure.
So how much do you see in your practice that people have a good understanding of the impacts of tax as a whole, not just in the active, investment period, but also post-retirement period, right? Because
Right.
in the post-retirement, you have this concept of,
Distribution.
retiring, distribution, RMDs, and all those different
Right.
things. At some point, you have to take that. But how much of that do you advise clients in general in terms of being able to
Oh, a
prepare
lot.
them? Mm-hmm.
A lot. We do advise a lot on that because, when right now, if you're just investing and not putting it into your retirement, you're in a higher tax bracket, obviously. So you're not, people have this tendency to, just for example, people have tendency to put it only in 401k up to the company, whatever they match, right? But what they're not understanding is, yes, the company is matching you 6%, but the remaining amount you can still save by putting it in your 401k limitation, where like it's 23,500 this year. So you can put it in that, maximize that. So in order to not pay in a higher tax bracket, when you actually retire, like 70 years or 80 years, whenever you retire, if you take that money out, you are at a very low tax liability than right now. So that's
Mm.
one of the opportunities we see a lot. And then the other thing is also contributing to a tax deferred plans rather than just going into the traditional IRA and things like that. Roth IRA is a great opportunity to put in the money now, and even people who are doing for 529 plans for their kids. So they do 529, but let's say one of my kids want to go to a Harvard or somewhere else. There's not enough money to pull out for the college tuition, right? So they open a Roth savings account. So in order they can contribute to the Roth savings account, and if you directly send the money to the college, you don't have any tax consequences either. Whether it has to be after 5 years, but once you put in that, you don't pay any taxes. There's no taxes on the growth, or there is no taxes on the contributions. So those are some of the things. And the other thing, the biggest one is I see that qualified opportunity zone. So that's where some people are aware of it. Not a lot of people are aware of it. Like especially when you're making money in stocks, you can obviously the RSUs. This is one good example, right? The RSUs that are vesting, let's say it's vesting in December, you sell it right away, and then you can invest in a qualified opportunity zone where there's no tax consequence. You still have 2 years down the road. Like it's not too late to even now start putting it in there. So that way, you can contribute there, you can put it in there, and then when you actually take the money out after 10 years, whenever, there is no tax consequence. It's tax-free money. So you can definitely talk to their financial planners like yourself, and make sure they are diversifying their investment and not
In
just
fact, we
putting it
we
in one.
have a partner who does a lot of QOZ based
Yeah,
REITs.
great.
So they develop these opportunity zone investments, and they offer that at a incremental level of like $50,000, 50,
Yeah,
100, 150, that kind of thing. So that's a great avenue. A lot of people don't know the
yeah,
QOZs. What other tax havens are there? Like QSBS is something that I've heard,
yeah.
where people
QSB
can
and
invest in. What is
yeah,
QS? Can
yeah,
you tell a little
definitely.
bit of?
There like you have to really sit down and put numbers together in order to really go into the planning session. So it's not just even if you advise, it doesn't mean that it may work for somebody, right? So they have to really, it depends on individual situation, right? It's not everybody fits in one shoe. So it's the same way, different multiple opportunities are there, like Roth, like, qualified opportunity zone and QSPs, things like that, where people can make an informed judgment and then put it into action by talking to their financial planner and the tax planner. So that way it's all coming in together, and they kind of save on taxes. At the same time, they're not paying more, and they're saving for the future for their kids. And obviously you have partnered with estate and trust. So going into that depth is also something that they want to look into. So that way, for their kids' sake, or even for their own sake, it's a good thing to have the estate and trust planned already. So that way we are not sitting, once someone passes away, we're not sitting and thinking that, oh my gosh, I should have done this before. It's always, sometimes when you don't do the planning beforehand, it's always after the fact. You can't do anything about it after the fact. So
Sounds great.
definitely
Yeah.
good opportunity to do these things when you are able to, and when you have that growth, and when you have that income to spare to put it into smart savings.
So
Smart
if somebody is already having a tax filer, let's say, many of us go to online like TurboTax, for example, we
Yeah.
don't get that additional advice from a planner like
So
yourself. So we can come to you while we are comfortable with the TurboTax for the simplistic thing. We can always have a session with your team to
yeah,
give an overview of like where there are tax opportunities, savings opportunities, not
absolutely.
just for this year, but for the future
Yeah.
ahead, right? Okay, that's great.
Absolutely. So
So,
just to say a little bit on that, Sham, TurboTax is only as good as you are, right? So in the sense, like, if you know all the rules and regulations, great. TurboTax, you don't need anybody else to do it. But in this day and age where things are changing every day now, it's not even
mhm.
by year. It's every day there's something that's coming up, like, oh, this is the law, new law we passed, this is what we're going to do for this year, next year, things like that. When it changes, you want to have somebody to go to confidently say that, hey, I am here, I want to know how much can I save on these, what should I do in order to even bring in more income, and at the same time not pay as much taxes. I
Right.
see this all the time. Like people, in fact, a lot of people do TurboTax and then they regret because they are not getting the advice that they want. Like I said, you can make mistakes. Even if you know the law, there's things that if you answer a question wrong, you can make that mistake and it can come back to bite you. So
Right.
definitely, I would say strongly that, definitely look for a tax professional that will go hand in hand with your financial planner, not just any tax planner. Someone, I'm not saying everybody has to come to me, but it's just that it goes well when you have the financial planner and the tax planner talk to each other and make these informed judgments for you and informed decisions that you can make.
Sounds
So,
great. Yeah. Yeah. No, we are introducing a lot of partners in this. We are now going to announce a new partnership with an accounting firm. They are not more
mhm,
in, they do taxes, but that's not their primary
right.
focus. They're more into setting up of the business for success,
Yeah.
all the way for the journey of the business, right from the inception to
Right.
exit. And we have a lot of our clients who run their own business operations. And so we are going to keep introducing new partners in the
Right.
ecosystem of finance as a
Absolutely.
whole. One question, we have, I'm looking at the attendees, some of them are very close to the retirement age. And
Hmm.
I do see a lot of people who are much younger in our clientele that has joined here. So for those folks closer to retirement or just post retirement, right? The biggest question that they have is, what's the schedule at which I can convert my IRA into Roth IRA so that all my growth into the future is going to be tax free? And you've got a timeline before RMD kicks in, that whole planning, even though you have some software tools that does that, similar to what the example you said, you're only as good as TurboTax. You're only as
Yeah.
good as the tool that gives you those what if
Hmm.
scenarios and all those things.
Yeah.
So do you guys take a look at, the current, holdings that they have, the account values that they have
Yeah.
in retirement, non-retirement, etc., and come up with a schedule that they can operate to reduce the post, RMD kind of tax situation? Because
Yeah.
once you start RMD, then tax really kicks in. Is there a way they can mitigate or minimize the taxes and keep that growth forever until the life expectancy, let's say 85, 90 years, that they don't have to pay even a single penny taxes beyond that? Do you provide that kind of service?
Absolutely, absolutely. This is all we provide for a lot of my clients. They, even though they may be younger or older, it doesn't matter. So we do provide that schedule. We say like, if you start contributing here, so when they come to us, like if they are a younger generation, then we tell them to, okay, start moving, shifting your money towards the Roth concept slowly. You don't have to do it all in 1 year. You have the time to shift the money between the tax advantage, tax deferred accounts. So we start moving the funds slowly, so that way you're not paying too much taxes in 1 year at one time. And for people who are already closing to that stage, like maybe 3 years, 5 years down the road, do it in conjunction with your financial planning as well. Like, if you have stocks that you're selling, and see whether you can move that, you can sell the RSUs or whatever stocks you have, and then move it to a Roth account. So that way, you're minimizing your taxes when you actually take it out in your retirement. You're not paying taxes on that. So slowly, that's where we both work hand in hand to collaborate and give them that benefit of talking to an advisor, talking to a planner, so that way they don't make those mistakes after the fact. And after someone, I see this all the time, like they have businesses. I have business clients who, like, oh, I forgot to mention I already sold my business, or I already sold this, I did
Yes.
sell this fixed asset. I'm like, okay, when did you sell, why did you sell, what's happening? So when I tell them, you could have done this way, so you could have saved more on taxes, but oh well, we can't do anything about it now, but in the future, remember that. So they always feel that comfort level to come back to us and say, okay, we're I've kind of gotten all my clients used to me bugging them and telling them that, stop. Think about it. Even if you're making a small sale or whatever, business asset or anything, talk to me or any tax professional before you make that judgment, so that way you know what you're getting into.
Right.
So that way, you're informed with all the planning that you can do before even you go into that next step.
Right, right. No,
So
so many times
definitely,
it becomes an afterthought.
yeah,
Recently, we had a client who sold close to $120,000 of like capital gains without realizing, and the advisor that she was working back then also didn't realize that there would be a huge capital gains impact to
yeah,
it. And net now she has got to spend $20,000 in taxes, which could have been avoided. So there are a lot of
yeah,
anecdotal examples that we come across every single day of how big the topic taxes and how little people are aware of all the consequences of
right,
that.
right.
So we have a lot of attendees today in our clientele who are much younger. I wish I was that young. Uh, but
Mm,
what would you advise them? When they come to investment advice, we say,
mhm,
don't do the mistakes that we did, which is
right,
not invest enough in the market in the growth stage when you're in 30s and 40s, where your market is giving all that opportunity, but we are sitting on like just sitting in cash or investing in like money
right.
market funds and stuff like that. So that's our biggest piece of advice to investors is to
Mm-hmm,
believe in the growth system, which is US. You don't need to be too smart, just invest in S&P 500. But
right.
if you don't want to do any crazy stuff, just do that. But then you'd be very happy when you're at the 50s that you wish
Mm-hmm,
you did you're glad that you did it rather than you wish
right.
you did it, right? So what kind of similar advice would you say from a tax point of view that people younger should start planning for, so that they don't say I wish I did that when I was in 30s?
Right. So the main thing is don't have everything in one place, right? That's the main biggest advice that I would give for all my clients, whether younger or older, doesn't matter. Don't have everything in one stock or everything in one investment. Multiply the more diversified your investments are, the more you can multiply your wealth. So, if you have the money to put it in your retirement, put it as much as you can. And then, maybe, if you have a business, then, look for ways to how to minimize your taxes, how to maximize it. One thing that comes to my mind is always people choose the wrong entity. So they're not sure. They start off as a business, they start off as working from home. And, even for me, I started off working from home, and then now I have a huge office, and, I have six employees that work with me. We are a team and we do this all the time. So what we suggest is, like, if you're small, it's okay. You don't have to have the same structure when you're growing. You have to revisit the structure you were in when you started, and now you're probably making $1 million, and then you want to make sure you are mitigating your taxes to a lower tax liability by taking advantage of the entity structure, by taking advantage of the right structure that you can and you should be in, right? So those some things that, definitely, think about all those things. And then definitely diversify your investment, by like rental properties or good real estate investment is great. And, obviously now cryptos are great, Bitcoins, whatever, all those things. You can start if you have the money to play around. Just, it's okay to come out of your comfort zone and play around a little bit to see where you stand and where you can make that money. So that way, you have a fixed, like, you have a good investment strategist that they're working with you, so you already planned their most of their stuff. So, one account where they can play around with a little bit of money to see where they can diversify. And, they can talk to you and talk to us, and we can both together jointly plan for them how to go about not putting everything in one place, and we
Right,
can
right.
diversify it.
And
So
there,
definitely that's
yeah,
something I would advise.
this is from a conversation I had with one of our clients. I think she's also joined the call today. That's great. So this question was about, the investment, non-retirement investment has grown to a decent amount of value, and to an extent where if it's treated as an LLC, then you can take some advantages of like using your property, a portion of your property for tax advantage, because it is a profitable venture. Like if you imagine, let's say $1 million of non-retirement account is being invested in the market and it gives like 15% return. So it is generating like a $150,000 on an average kind of return. Now, of course, there are going to be taxes there, but some of them are long-term investments, etc. But because the primary house is being used for this
Mhm.
business,
Yeah.
are there advantages of converting that into an LLC entity? Of course, that will go against the SSN number or the individual tax identification number of the individual. So there are no differences in terms of how they're going to be taxed, but it can potentially reduce the taxes by writing off some of those taxes, some of those capital gains against the expenses. You meet up people, you go to a restaurant, you do some, dinner. There
Yeah.
are all these different tax ways to avoid some taxes. Do
Mhm.
you see many of your clients do some things like this, or is not really heard of that much?
Absolutely, absolutely. It depends on what structure you have. Like if you have a business you own, I mean that you're making $1 million, then I would structure that not just as an LLC, but an S corporation, so that way they don't pay unnecessary taxes, double taxation, right? So if you are just a sole proprietor, then you're paying regular taxes, whatever your tax bracket is. On top of it, you're paying 15% self-employment tax. So I suggest them to talk to your tax planner to see whether you can make it as an S corporation. So that way you're taxed only at one level, and at the same time you also get a different deductions and contributions that you can make to your retirement account. As an employee, like W-2 employee, you can only put in like 23,500 whatnot, but as a business owner you are able to contribute more to the SEP IRAs and Roth IRAs. You have up to $70,000 that you can contribute to a SEP IRA in total, right, with all your retirements. So that's a huge number to save in a year. That if you can do it, absolutely, I would highly recommend talking to your tax planner to see whether that's something that you want to do or not. The taking the home office deductions and all that is very minor. So when you're a small business, yes, all that, every single penny matters for sure. But
Yeah.
if you're making more money in your business, I would strongly suggest to revisit. And even if you have shifted like money from, like, say you were making 200,000, now you're making like 800,000. That shift is a huge shift. So that you want to talk to your planner to see whether what is the change I should be doing. What
Hmm.
can I do? Where can I do some deductions? What all deductions can I get? How can I save in my retirement more when if I'm making that kind of money, right? So those are the things that it's a one-on-one situation. So it's not something that's for everybody, but as and when we get clients like that, we kind of go over everything as a wholesome tax planning, not just one portion of it,
Great.
right?
Yeah.
So,
So one question for this last question before I go to Q&A. Actually, there's this one question about OBBA, the one beautiful bill, right? Whatever
mhm,
that is, Trump's bill. There are some attendees here who are very young with like kids still going to school.
mhm,
There looks like there are some tax advantages of opening a brokerage account for them, where they can get not only money invested on a yearly basis on a tax advantage basis, but also the government, U.S. government, giving the initial $1,000 to seed that
yeah,
account. So this is a big initiative that's going on across all the
right.
different brokerage firms. So, what other salient points from a tax point of view are there in the bill that people need to be conscious before getting into 2026?
Sure. There's a couple of things that are really, it's not everything is not favorable or everything is favorable. There are some things that are really favorable. One is the itemized deductions, definitely dollar to dollar benefit. So previously, until last year, there were SALT limitations where you can only take up to 10,000 of your property taxes and other taxes that you have, state taxes. But now they have removed that SALT limitation. So what you can do is, basically people are paying high property taxes. Like even in Texas, we're paying like 18K to 20K of taxes, but we were only able to take 10,000 until last year. But
Right.
now they have increased that limitations, and the total itemized deductions, they have expanded some of it, and there's limitation on the amount that you can actually take overall itemized deductions can only be up to 40,000 for property taxes and things like that. Those are all some of the things that you can definitely, venture out and definitely, utilize those items. And some things like, child tax credit, and they're able to put in more into their dependent care, FSA account and all that. So those are all some of the strategies that we use to lower the tax burden. At the same time, now if you see all the young investors, they complain. I mean, not complain. They say that, hey, daycare expenses are so high, $20,000 to $25,000 I'm paying, but those are not. You can't take as much. You don't get as much deduction. The best way to do is to put in into your FSA for both your husband and wife, and then they can take that as a deduction. So, which is great. You're not paying taxes on that 10,000. Whereas if you just did the dependent care, you're only going to get $600 or $700 deduction. So those things definitely matter as far as all the OBBA is concerned. Even though there are some people that say they're like permanent low rates will still, it will still see higher effective taxes over time, even though there are low rates. Not everybody might be into that same deductions, and not everybody might have those things because they're
Hmm.
already in the 37% bracket, and you're now able to get, even though you're in a higher tax bracket, you're able to get that dollar to dollar deductions. And then how charitable giving happens, those are some things that you can definitely look into. Charitable contributions, they're giving $1,200 for each person if they're providing more. And obviously, if you're giving more, you can take that as a deduction. And then the aligning your asset allocation and realization strategies, which is basically like what we talked about, capital gains, loss harvesting, and things like that. Those are all some of the things that definitely benefit. This law is not to doesn't punish wealth. It just rewards people who plan earlier and coordinate better,
Oh,
right?
that's a nice way of
So,
saying, yeah. Hmm.
yeah, so it's not to punish their wealth. It's more to reward you for making it happen, for planning it, and then coordinating it with your financial planner and your tax planner, so that way you're not missing out on deductions, or you're not missing out on anything. I feel like people leave out money all the time on the table
Right,
because they don't plan, because they are not aware of some of these things.
right.
Now, like going back to your point, if you go to TurboTax, it's going to show you what it is. That's it. You don't know what changed. You don't know
Implication.
what's happening unless you are very thorough in going and reading the laws, going and knowing the laws, all of those things. That is why you want to go to tax professionals who are qualified, who can give you the most benefit for with including all of your finances together,
Right.
not just doing the tax.
No, that's a great point. Thank you for that. And also, as you said, it's rewarding planning. And I can tell that at least even $1,000 seems low, small as a starting
Yeah,
point, but the US government gives some money to start, and then it inculcates the discipline from the parents to invest on each and every child. By the time the child becomes 25, there's a huge corpus waiting for the child, and that's a
yeah,
big, discipline to inculcate at an early point in time for the children.
right,
That's great.
absolutely.
So with that, let me switch to a Q&A mode. Some of these you have already answered, but I'm still going to read out
Mhm.
from our clients here. So I won't tell the last name just for anonymity, but
Sure.
Balaji is asking, what's the benefit of self-filing the tax versus through the tax planner? What are the other insights we will gain from tax, which you just answered? So tool is a
So
tool. It
here's the main. Sorry to interrupt, Sham. Here's the main aspect of it, right? Yes, you can talk to you can do as your self tax filing. You can do just one time. With us, the benefit is that you can call me 10 times in a year, 20 times in a year, or one time in a year. It doesn't change. You are not a number for me. You are a client where you get white glove service, where you are the most important at that point.
right.
That we're talking to you, right? So when we talk to you, we are talking to you multiple times. It's not a one-time planning that happens.
Right.
So it is throughout the year, quarterly, you can call me,
It's similar
you just
to
decide.
investment advisory where we talk to the clients as a relationship
Exactly.
person
Exactly. That
from
is
an
the biggest
investment.
advantage of
Yeah.
going with a tax planner.
Of course,
So
of course. Yeah, there's a lot of parallel to like somebody self-investing in Robinhood
yeah,
versus talking to an advisor where there is a person to relate to on your investment goals, similar to the tax planning. You can
right.
just do a TurboTax like Robinhood, or you can talk to a planner like
Sure.
us. Yeah, great.
Absolutely.
Okay, let's move on to the second question from Sand. Do you help with optimized Roth conversions to minimize taxes while maximizing the total assets while taking into account RMDs and IRMA?
Yeah.
Is it worth paying more for Medicare with a few $1,000s to maximize Roth conversions? Or is it advisable to convert more into Roth when the market is down? Without knowing what the future taxes will look like, how do you model optimized Roth conversion?
So that's a great question. So here, that's definitely true. Without knowing what it holds for the future, obviously we can only plan so much, into the future. We can't plan for 20 years down the road. We can plan for 3 years down the road. Hey, what's your income going to be? What's your investment going to be? Like how you, as a financial planner, model projections, we will also model projections, and we will tell you this is what you will get when you convert Roth from, let's say you want to convert 50,000. Now this is the tax implication you're going to have. Whereas if you did it like next year, you may not owe that much taxes depending on how the market scales up. So there is no way of telling how it's going to be 10 years from now, but there is definitely something that you can revisit every year and every quarter or however suits you to plan accordingly. So you're shifting the tax payments and not just putting it all in one year. Like I had a client who came to me and his income was more than $1 million for last year. So he was in the highest tax bracket, 37%. He was asking me, he's already 70 years old, and he was asking me, hey, do you think I should convert all of my IRAs into Roth, traditional IRAs into Roth? What is the tax consequence on it? At 37%, there is no tax consequence. You're already in a higher tax bracket. So if you're already 70, it may be best for you to do a portion now, this year, and next year, who knows? You may decide to retire, or you may decide to make lower income. You may decide to make higher income. So you want to do it in batches so we can calculate, we can kind of guesstimate what it is, and then we can plan it and we can structure it that way. So that way he's not paying all the taxes now. And even if he pays some taxes now, he may be beneficial to do only 200K of conversion and not 500K of conversion. So it
Right.
really goes hand in hand when you talk to your planner and your financial planner. So that way, we go hand in hand and we decide. We kind of model what will happen if you did it 2 years from now, if you did it now, and how is your income going to affect, or how is your taxes going to affect. So that's how we model it. Yes, we do model for you within the constraints of how the market is acting now versus next year and versus 10 years from now. We don't
Okay,
know what's
great.
going to happen. So,
Thanks,
yeah.
Lakshmi. That's a great answer. So, anyone has any questions that I've not asked, please do. I have one other question here before I come to the last one. So, what are the fees you charge? Is it a retainer based or annual subscription or a one time planning? I guess.
So it could be any of it, right? So we have subscription basis. We have, depending on what clients, how the clients want it. It's up to what the clients want. We have subscription basis. We have preparation, and we have planning. It really depends on the complexity of how your situation is. Somebody might be making 500K. Somebody may be making $2 million. It really goes by the complexity of the how the situation is. Like for instance, for tax preparation itself, we go by the complexity because of the fact that we provide 100% accuracy guarantee. What that means is basically when we do your tax return, we do the planning as part of it. And also we provide 100% accuracy guarantee. If for some reason the IRS sends you a letter or notice and they don't see eye to eye with what we did, we defend you and we talk to the IRS, we deal with them take all the hassles on us, and you don't have to worry about it. And if for some reason they don't agree and we have to change it, we will amend the return. And if you end up owing taxes, you're still liable for the taxes, but we definitely will talk to them. And the hassle of dealing with them is a pain, and we do it on a daily basis. So we can handle that. So that's the reason the fees are based on the complexity and not by, it's not a one size fits all.
No problem at all. That makes a lot of sense. So I have a question here, which is
Yeah.
probably addressing to us in terms of how do you ensure my tax advisor, investment advisor, and estate attorneys are aligned and not working in silos? How do I manage tax exposure across generations so my heirs are enforced? So let me take the first question first, and then the part B of it. So how do I ensure my tax advisor they are aligned? To be honest, we are all governed by our own regulations, so we are not going to share your investment data to anybody other than you. So just because we are investment advisor and you're working with, our partners who are advisors on the tax side, we are not going to share that unless you want to share it yourself, right? Your data stays with you, and there are very, very tight regulations that we have to comply with, that our data is sacrosanct about your investments, right? Obviously, your investment data needs to go to tax advisors so that they can tell you how to minimize your taxes on capital gains, etc. But that needs to come from you as a customer and not from us. So that is some assurance I can give, at least from a Quantal's practice point of view. Your data will never ever be shared with anybody, including our partners, right? And I would like the same thing, that we don't want to know anything about your taxes beyond what you have invested with Quantal, even if you're working with Lakeline Tax or other partners that we have, because that's not a service that we are going to be providing in terms of giving opinions on broader tax things. If you ask a question, we would be able to give you that answer, but we just don't need to know everything that you talk to our partners, right? So the clear segregation is required, but all the data will be available to you that you can coordinate. We can give you the data that you can share with your tax advisor. So that makes it easy, integration, let's say, right, between the investment advisor who we are and the tax advisor, potentially the Lakeline Tax. We will give all the data on your request to you, and you would be able to upload the data to Lakeline systems and whatnot. So I hope that
Yeah,
makes sense.
Tom, can I add to that really quick?
Sure. Yeah.
So we work the same way, right? So we have our own secure portal and everything, and we service clients all over the world. So everybody uploads the documents on the portal, and it's very secure. It's very easy to use, hands-on, or over the phone as well. The way that I do like your question, because I see that you want everyone to coordinate. So the one way that we can do is once in 6 months or once in 3 months. If you think that your income has shifted, you need to really plan with your financial advisor and your tax planner, then we can do a conference call or something like that. We can set up a time so we can all be together, and we can guide you, and we can provide answers to your questions. That's something that I see happening, rather than having to share information from Quantal AI or from Lakeline Tax or from another estate or something. We're happy to guide you in any respect, as long as we're also bound by the data security and all of that. So we just want to mention that we will work in alignment, but you will be the main person leading that group or leading that conversation.
Sounds good. So before people walk away, as we are hitting the hour here, so if you are interested in Lakeline Tax, you can hit the button somewhere on your webinar that actually would set up a call, where we will facilitate that call as an introductory call, and after that you would be taking it directly with Lakeline Tax, as I mentioned before. So we are not going to be part of all the detailed discussion that you have on your taxes. To the extent that some of these things will cover investment, will provide all the data that you need to talk to them, but you'll directly deal with Lakshmi and her team, and we don't have to be privy to all the conversation there. Okay, so the next question here: how do I manage tax exposure across generations so my heirs aren't forced into large tax events? Here, just Lakshmi, before you answer this question, we provide a tool for all our clients in terms of creating a living trust and a living will and all those different things. The living trust is a huge advantage from a tax point of view as the generational shift happens from a wealth for the wealth. That is something that we provide to create a structure, an entity that will basically, not require a probate when somebody passes away. Also, the inheritance tax will not kick in, etc., etc. But do you have any other thoughts on top of it in terms of how to protect the generational wealth from huge taxes?
Yeah, absolutely. So when you do the estate planning and trust planning and all of that, this comes in handy. And we will look at your estate plan, what it has, and how you set up and how it's all done. Then if you are trying to give someone, like say you want to gift your kids like $100,000, is there any impact on it? We will go over all of that on a one-to-one situation, and we definitely plan with you to pass the wealth across generation, like you're talking about. And you want to always plan before, like I said earlier, not after the fact. So even if you have parents or older people that has these investments and everything, you want to talk to us before. Like obviously everybody is getting older, and everybody has their own limitations on how much they can manage. So you want to talk about it to your to us before even we can say that this is exactly what you do, what you need to do. We will guide you with the steps how to proceed with the maximum savings on taxes, and how you can pass your money wealth to generations from you, for sure.
Okay, great. Thank you, Lakshmi, on that. So because we have only 10 more days of trading, rest, remaining in the year, active days of trading, uh, from a capital gains point of view, what are the kind of things that you would advise your clients to just finish the year on a high, ensuring that they've not lost that opportunity before the year gets over?
So again, so you want to look at your investment as a holistic view and not just one part of it. So when you take it, if you have a plan to sell stocks because you want to do it because it's at a high, then you kind of see where your tax liability is, how much you've made in the year, what is your capital gain, do you have any losses to offset it, do you have how we can mitigate it to a lower tax liability, do you contribute to a Roth, or do you convert to a Roth, or do you want to put it in the qualified opportunity zone? There are multiple ways you can do that. So if you want to reach out to us, we are available to discuss these options next week. So we definitely can help you plan that around those scenarios.
Sounds great. Yeah, I already see a lot of people signing up for setting up a meeting with you, Lakshmi.
Okay,
Thanks a lot for
sounds
that. So
good.
we'll coordinate with you on that. But yeah, book the time, folks, if you're interested in just having a free conversation with Lakshmi and her team in terms of what they can help. So our goal is simple, right? We want to connect our customers, think beyond investments. Of course, investment is a very important aspect of growth that we focus on, but we want to make sure that there are other opportunities, as Lakshmi started off with. While we focus on the investment returns, the biggest drag on that is taxes. So we need to really be focused on that to maximize on the return potential and whatnot. So with that, I'm just going to wrap it up. Thanks a lot, Lakshmi. It's been a very, very engaging
Absolutely.
conversation. I'm sure our attendees here, most of them are our clients, would benefit a lot on this information. But I'm going to replace one request is, this is not a one-time thing.
Yeah.
While we make it available for people as a recorded video, this content will change as time
Yeah.
progresses. Everyone's situation changes in terms of their, financial wealth and tax situations, etc. So I think it'll be good to have one more session into the next year, probably closer to the tax filing season.
Yeah.
If you can, give us an hour of time, then it would be
Yeah.
good to invite you back to our customers to interact with you.
Absolutely. Thank you so much for having us here, and we would love to do it again. I'm all honored and glad to service your clients and make them my clients as well.
Great, awesome. Thank you very much. Thanks a lot for
Thank
everyone who
you.
attended.
Thank you,
And this
everyone.
this will be available as a video on our YouTube channel. We'll also send the link to our WhatsApp group in terms of where to find it. And if you are interested, just reach out to us at any point in time. There's a button there. If you miss the opportunity to click a button, just send us a mail, and we would be happy to connect you with Lakshmi and her team. Thank you. Thanks a lot.
Thank
Bye.
you so much. Bye.